In the United States, control of the economy is divided between the government and the private sector. It operates as a modified free enterprise system, often referred to as a mixed economy. This massive system involves hundreds of millions of individual actors and trillions of dollars in continuous, overlapping motion. When these massive market networks are left entirely to their own devices, they generate severe and often destructive volatility. The turning point for managing this volatility was the 1930s. The Great Depression demonstrated the human cost of an unmanaged economic collapse, leading the federal government to take an increasing role in managing the nation's economy. To smooth out these dangerous highs and lows, the government now utilizes two distinct parallel control systems: fiscal policy and monetary policy. These systems do not replace the private market. Instead, they represent a division of control between public oversight and private enterprise. Managing the country's economic health involves the continuous adjustment of these two asymmetric sets of levers. The first system is fiscal policy. This toolset is controlled by the President and Congress. The federal budget functions like a control panel with two sliders. Pulling taxation down leaves money with consumers, increasing demand. Pushing spending up buys labor and services, injecting money directly to increase economic activity and put people to work. Fiscal policy faces a significant mechanical challenge: execution lag. It requires political consensus to react to fast-moving downturns, a process that is often too slow to impact a sudden economic shift. These levers are also asymmetrical. While tax cuts and increased spending are politically popular, they are difficult to reduce once the economy recovers and the public becomes accustomed to certain services or programs. Because the government rarely collects enough tax revenue to cover this stimulated spending, it must borrow the difference. This results in budget deficits. In 2013, this deficit represented about 6% of the gross domestic product, the total market value of all final goods and services produced in the nation in a year. The Fiscal Control Panel is a heavy instrument. It is capable of massive, direct economic stimulation, but it is prone to slow response times and the accumulation of national debt. The second system is monetary policy. This involves managing the actual supply of money and the cost of borrowing to meet the economy's needs. In the United States, this responsibility belongs to the Federal Reserve System, or the Fed. Established in 1913, the Fed was organized as a privately owned stock corporation. While commercial banks own shares in the Fed, a board of governors ensures it operates in the public interest. To insulate it from political pressure, the 7-member board of governors is appointed by the President and Senate, but they operate independently of the rest of the government once they are in office. This board supervises the entire system, including 12 distinct Federal Reserve Bank districts across the country. The Fed operates under a 4-part mandate to promote sustainable growth, high employment, stable prices, and moderate long-term interest rates. This structure creates a highly technical system, deliberately removed from the political pressures that drive the Fiscal Control Panel. The Fed is often called a banker's bank. Just as individuals borrow from banks, commercial banks borrow from the Fed to meet their own liquidity needs. To manage the economy, the Fed uses a precise control panel with 3 primary dials. The first dial is the discount rate, the interest rate the Fed charges member banks. When lowered, banks borrow more money, offering lower rates to customers. This stimulates the economy by making credit more available. These rate changes have a major impact on daily life. Lower interest rates encourage a family to buy a home or businesses to hire workers. The second dial controls open market operations. Here, the Fed buys or sells government securities, like these bonds, to adjust the money supply. Buying bonds injects fresh money into the economy. If the Fed determines inflation is growing too fast, it can sell these securities, which takes money out of circulation as investors spend their cash to buy them. The third dial is the reserve requirement. This is the percentage of money that member banks must keep in their vaults or on deposit with the Federal Reserve as a safeguard against withdrawals. Raising this requirement leaves banks with less money to lend. However, the Fed is reluctant to use this tool because other monetary policy instruments are less disruptive to banking operations. While the fiscal panel injects money directly, the monetary panel acts as an agile valve, indirectly influencing the economy by expanding or restricting credit supply. Both control systems influence the same economic network, but the President and Congress have no authority over the Fed's dials. Because these systems operate independently, they frequently conflict. Politicians might push the fiscal spending slider up to stimulate growth, flooding the system with capital. To stop inflation, the Fed moves its dials opposite, raising the discount rate to choke off demand and stabilize prices. This can lead to political tension, with lawmakers complaining that the Fed is interfering with their economic programs. The Fed's independent structure is designed to allow the Board of Governors to make decisions based on mathematical necessity and the long-term health of the dollar, rather than the pressures of an election cycle. Systemic friction occurs whenever the government's political priorities clash with the Federal Reserve's mandate to control inflation and stabilize the economy. Gauging whether these systems are performing correctly requires monitoring a variety of economic indicators. Analysts look at stock market indices, employment levels, changes in the prices for goods, and surveys of consumer sentiment to determine the condition of the economy. Investors watch the Fed and Congress closely because a single adjustment to a slider or a dial can change the cost of a loan or the rate of business growth. Fiscal policy continues to rely on the political instruments of taxation and spending to shape the economy's direction. Monetary policy provides a faster, independent method of credit regulation to manage the money supply. The U.S. economy functions through a constant, delicate tug-of-war between the political priorities of the capital and the technical mandates of the central bank.